Good morning, everyone. Welcome to Gerasi LLP's first YouTube live broadcast. My name is Kevin Kim, partner at Gerasi LLP. I'm a securities attorney. So we're trying out something new. So thanks for joining us today. This will be a new way to share our view and content and ideas with our audience. Before we get started, so make sure you hit the subscribe button below if you're interested in learning more from Gerasi LLP. If you have comments, please leave them below as well. This is a live, so make sure you also, if you have questions or you want to leave comments in the live, please use the chat box over there. And yeah, so today's focus is going to be about recession-proofing your lending business. So at the last American Association of Private Lenders conference, Nima Dagbandit and I did a panel on preparing for the next cycle, preparing for 2019, and how to really be bulletproof. And someone else asked me, well, how do we talk about preparing for the oncoming, I guess, recession, right? And so, I get these questions a lot. I create funds, I create businesses, I create corporations and LLCs, and I also get clients licensed to lend. So I get a lot of questions about, how do I set this up right? And then once we set them up, how do we stay out of trouble? How do we avoid issues in, even in an upcycle, but how do we also protect ourselves in a down cycle? So, the format for today is just going to be question and answer, so please type in your questions in the group chat or in the chat on the side. We do have some questions that I've gotten before. We're preparing for this YouTube Live today. And so, the first question that we got was from a client. He actually asked, are you sure that a recession is coming? Like, what realistic signs tell you that a recession is coming? Well, I'm not telling you doom and gloom, oh, run for the hills, it's coming. Number one, that's not what I'm saying. What I'm saying really is that we have to prepare. We have been in basically a 10-year upcycle, strong economy. Rates are coming up at the Fed level, but in private lending and non-conventional lending, yields are coming down. And so that coupled with home value stabilization, all kind of telltale signs that it's not as hot and heavy as it was 3 to 4 years ago. And so what does that mean? It's time to start thinking a little bit about being practical. I read an article the other day from the, I think it's ATTOM, the Data Solutions. They put an article out recently saying something about, foreclosures are at an all-time low compared to last year, bank foreclosures, this and that. It's true, bank foreclosures have declined, but banks are also not as aggressive in the lending market as they once were. What I would tell you is look at the private lending market, the non-conventional lending market. As a law firm, we do represent a lot of non-conventional lenders. That's our core business. And foreclosures compared to this time last year have increased by double. So that's a sign, right? And that's one of the reasons why I think maybe it's time to start preparing, not running for the hills, but starting to think about some practices that will improve the way you operate today, but also protect you if things start to trend downwards and some trouble starts to hit. And also, just historically speaking, in the last cycle, toward the mid to tail end, you saw a lot of institutional money flooding the market. Well, for all of you who are non-conventional lenders out there, past 3 to 4 years, that has been the case. So I would say that it is time to start thinking about preparing. Another question we got was, I'm a lender, private lender. I've got a fund. I'm having trouble balancing or justifying, preparation or preparation mindset. And balancing that with my investors' needs, right? I've got to make deals happen. My investors are coming in. I'm constantly raising money. I need to keep my investors happy, right? And this is one of the major concerns when it comes to recession proofing, if you will, preparing for the recession in the private lending industry. funds are what you make of them, right? There's no requirement in any fund that you are constantly out there raising money. You as the sponsor have the choice to continue to raise money. You as a sponsor will have the power to, slow down operations and slow down capital raising. And on top of that, you also going to have to start thinking about, what deals am I uncomfortable with? And as a fiduciary, you also have to ask yourself, even if there is a lot of investor demand, is this the right thing for the investors? And then from a legal perspective, we always tell people, look, there's what you can do and what you should do, and there's what you've told investors, and that's the most important thing. In the world of securities, you have to make sure that what you disclose, you stick to it. And so if you disclose an X, Y, and Z credit box, but because of the way the market is working, you're having to kind of loosen those guidelines a little bit. I would start thinking about, how do we kind of reevaluate what we're doing today? Because ultimately, taking on more risk to feed your investor needs is really just going to feed the beast, if you will. And you may lose sight of some of the incoming risks and incoming changes because you're so focused on that, and it may be too late. So start thinking about what kind of deals am I taking on? Am I taking on too much risk? Start being willing to say no. One of my clients asked me in this context, my fund, Kevin, what do you think? I think I should kind of slow things down and stop raising so much money. I'm like, well, yeah. Why? And he told me, well, my market. He's in California. My market, we're seeing a lot of rate compression. We're seeing a lot of competition. I don't want to start raising my LTVs. I don't want to start doing more risky loans. My investors don't like that. I don't like that. And I told him, well, maybe it is time to start thinking about a more permanent solution for your investors and trying to cycle their funds to do quality deals that make them happy. And that kind of goes to another topic. One of the things that people ask me a lot when we're creating a fund is a lending fund. What are some key features that I need to have in my documents? Because one of the questions that a lot of new fund managers ask me is like, when I create a fund, how do I set it up in a way where it's going to protect me as a sponsor? And we always talked about this over the past few years at conferences, and I always tell them, number one, you need to have a lot of authority as the manager and as a sponsor, decision-making authority. You also need to have certain key features that I think are indispensable. You need to make sure that you have the ability to essentially, I call it the emergency brake. You have the power to really halt operations, halt originations, halt distributions, halt and suspend withdrawals. And really, in the event of a significant portion of your portfolio starting to kind of stink a little bit, maybe you're starting to see your foreclosure or default rate kind of climb up a little bit, instead of filling it with more deals, start thinking about, well, okay, maybe I should start playing capital preservation mode because things are starting to look a little bit sketchy, right? And so that's part of it, having the ability to do all that. And also for the sponsors out there, for the lenders out there, making sure that you have the right indemnification clauses and stuff like that to make sure that you're protected, because ideally you've been doing the best thing in the best interest of the fund. The last thing you want is the fund saying that you didn't do a good job just because yields are going down or defaults are going up. So great. So one of the questions that we got is aside from the legal side of things, we talked a lot about legal. What are some business tips or tricks or advice that you can give about improving my business, my lending business, to help the recession? And this goes to, and I've been talking about this for years at different conferences, is process and procedures. You could be the best loan originator, you could be the best capital raiser, and you can be the best salesman. But you also have to start thinking about, is your business operating in a way that mitigates risk that could seriously conflate into a major issue and cause you a lot of heartburn? Simple as file management, right? If you don't have good records and good record keeping, and loans are being transferred here and there, how do you manage that if you go to litigation, right? How do you, what are you going to do if you have to track things down? Taking care of the essential steps in originating a loan from start to finish, right? Don't cut corners there. Making sure that all the necessary pieces are in place, all the right policies are in place. Is your title sound? Are the exemptions, your title policy, do they make sense for this loan? Are you following the guidelines of your PPM? Are you lending within the guidelines set forth in your credit box, in your investor memos? What does your foreclosure process look like? Do you have one? Do you have a processor for that? Do you understand the time frames to convert into REO in the given state? Can you? If you lend in multiple states, what are some of the differences between processing a foreclosure in those states, and do you have protocols for that? Because what happens is if you are unprepared for those situations and you start seeing a kind of an uptick in foreclosure or default, you're unprepared. Unpreparedness can cause, delays, and delays mean time equals money. So I would tell you guys, think about having someone look under the hood, if you will, not just from a legal perspective or an accounting perspective, but also, is my business operating in a efficient and productive way? And is there any inefficiency that I can remove? But also, is there posterity in mind, so I can make sure that if something does go bad, I can really step in and repair it. It's one of the big things that we always talk about. Let's see here. Let's take a look here. We got a question here about, well, what do you mean about you basically, it's what do you mean, what does run on the fund mean, basically? So what that means, and I want to talk about that real quick. I've talked about this at other events and on different webinars and different articles, and the issue is on run of the fund is really simple. We all remember the run of the bank, right? Back in 2008, when banks shut down because of various reasons. And one of them was because deposits were essentially lost. And same goes for a fund, right? A fund is a lending business. It owns a portfolio of loans, and your investor's capital is in the fund and in those loans. So if things start to have, some stink to them, and the economy starts to downturn, and the recession starts to happen, or even if media makes it bigger than it really is and stokes fear in the investor, they have the ability to request their money back. And that really is what I'm talking about, run on the fund, right? How do you protect yourself from investors running to you and say, I want my money back, and basically causing a debilitation to the fund? Well, that's what we talked about earlier, right? So that has to do with what I would call protections for the fund manager and also for the fund, right? One of the biggest things I tell fund managers, if you don't have that emergency brake I was talking about earlier, and that partially goes to suspending withdrawals, and you don't have limiters on the amount of money that can go out every year in the form of withdrawals from your fund, you really risk yourself on this run on the fund concept. So really take a quick look at your offering documents, take a quick look at your business and your investors, and how easy is it for them to exit their money from your company, and do you have the right tools in place, legally speaking, and also procedurally speaking, to protect yourself. So let's take a look at these questions coming in here. All right. So one of the other questions that I've gotten before here is, I've been thinking about getting a line of credit. Is it the wrong time now? No. I don't think it's the wrong time. I think it's actually from obtaining a line of credit for your lending business. It's actually a great time. There's a lot of banks out there right now returning to the credit facility space or the warehouse lending space for private lenders and specialty lenders. But there is something to be thought through there. You really need to make sure that you're not overdoing it. If history teaches us anything, a vast majority of lenders in the last cycle suffered significantly because their lines were called and they happened to be over-levered. And some of them weren't even over-levered. Some of them were just one-to-one. And that was really debilitating for them because the lines are called, they can't pay it. Well, here we go, right? And so now their portfolio is at risk. Thankfully, nowadays, the credit facilities and warehouse lines out there are a little bit different than they were back in the last cycle. They're usually not these blanket, secured lines of credit. Now they're usually credit facility structures, and that helps a lot. But you still want to make sure that you do not over-lever your fund. And the reason why is the same reason I just mentioned, is you just do not want the bank on their end feeling, okay, we're starting to feel a little bit uncomfortable about this market. It's time to do an autopsy on all of our warehouse lines of credit or credit facilities, and then start calling them if they, for whatever reason they have in documents. And even if they do it in violation, you still have to deal with the legal fees and fighting that. So I would be very careful in how you do it. Thankfully, though, everyone that I've been speaking to lately on credit facilities and warehouse lines have taken that lesson from the last cycle. They aren't overdoing it. They aren't, 100, 200% leverage, all that kind of stuff. They're taking it a very conservative approach, and I commend them for that. And you should continue. Another question I got was about, my business is essentially origination and correspondence or loan sale. Does this pose a risk in the next cycle? I think it can. I think it's concerning if all your eggs are in one basket in general, especially in a basket you can't control. The position that I take on this is relatively simple. Have balance in your business. Correspondence and no purchase and secondary markets are great. They're fantastic. They provide a great avenue for lenders to fund their deals. They still have great economics for the originator, and it allows lenders to scale significantly. But you do have to really take a hard look at that master purchase agreement and arrangement you have with them, because they are still a third party. They are still essentially a financial institution, and their interests are their own. They're not really looking out for your interests. They're looking out for their own. And that's not good, bad, or indifferent. That's basically the truth, right? Everyone has their own interest in mind. And you as the lender, you as the private lender who have your own investors, your interests are your own and to your investors. And so you want to make sure that you kind of balance that, because the last thing that we want is for lenders who have relied a little bit too much on secondary market or correspondence, having the same situation happen as the last cycle, and have a lot of these buybacks being called up, or takebacks, or litigation caused by technical breach of the purchase agreement. When everything's going good, they'll kind of overlook a lot of those technical violations, but when things start to look a little bit troublesome, that may change. And if you look at where the market's heading with that, it's important, because you really have to think about, in the aggregate, what are they buying, right? What are they taking on as a correspondence program? Well, these are typically institutional type companies, and it's pure capital markets. It's pure financials, right? They're looking at it from a return perspective. And so there is going to be a time when too much is taken on and defaults on the rise, and those buyback rights are really going to start being called up. So it happened in the last cycle. Back in the last cycle, there were several correspondence programs back before this trend of business purpose and commercial, lending, and it was the same trend. A lot of folks were buying paper, a lot of folks were offering correspondence, and when the last cycle ended, the Great Recession, we had a lot of litigation because of a lot of the buybacks, and a lot of the smaller shops were forced to shutter. And so I tell clients who rely on correspondence, just make sure you have an imbalance. A fund or a lending business where you work directly with investors can absorb a little bit more because there's that relationship. That relationship can manage a lot more, heavier currents, if you will, than a bank or a financial institution. They're not going to weather those currents. Why should they? So, and that's going to be the concern. Another question I got on this is in lending, and if you've got a fund, is are there any insurance products out there that can help me, or what insurance should I get? Well, if you're at a lending business and you have an actual brick and mortar operation, general liability is going to be important. If you've got employees, workers' compensation. If you've got a lot of employees, I would recommend you start thinking about employment insurance. But for the clients that have a fund, the clients that have a large lending operation, anything over roughly $30 to $50 million in assets under management, I would start thinking about a E&O or D&O insurance. I know it's expensive, but it can be very useful. There are companies that kind of specialize in this space, and so you can look into it. I believe there are some groups at different conferences that offer the E&O and D&O product for mortgage funds and private lenders. So it is worth it if you get to a certain size. And why I say that is because at that size, the premiums become manageable. The premiums are pretty high, so you want to start thinking about that. Let's see here. One of the other questions that I got on a call recently from a client and about this webinar and about this YouTube Live was essentially, why should I start lending in multiple states now? He agrees with me that there is some kind of indication that things are going to stabilize or start kind of head downwards. And I told him, well, the number one reason why you should is because you can still do quality deals and not chase as much risk in what I would consider still, metro infill A markets that are in another state, right? For example, we recommend Texas. A lot of Texas is a very good metro infill market, great lending state. And they have great foreclosure laws, and you can do a lot nowadays in protecting yourself on the underwriting side with the right appraiser or BPO and that kind of stuff, and evaluations, as long as you don't overdo it, and that you don't go too high on that LTV, right? And so, and that's really important, because not only do you offer market and geographical diversification, but you can still stick to your guns in a lot of these states outside of California that there's not as much competition. And that kind of goes to another question I commonly get is about, should we start reevaluating our portfolio and our credit box? My answer is yes, absolutely. You should be reevaluating. You should be reevaluating it every year, actually. Look at your credit box every year and determine whether it's, in what we just went through this past year, is this the right position to take this year? Should we be taking on more risk? Should we be exploring other markets? Should we be changing our product list? That's all important. Let's see here. We got another question the other day about kind of the market, and this goes to the whole debate about whether there is a potential recession coming in the near future. You know, when we did when we started the firm, you know, it was we started the firm 10 years ago, and quote unquote hard money was really booming, and we realized then that, you know, it's a matter of time before institutions come in play, and there's going to be a lot of competition in the market in these big real estate markets in California, you know, New York and stuff like that. And we did not foresee the speed in which the market would shift. And what I mean by shift is, so we did a survey as a firm of, I think it was about 500 of our clients, all private lenders, non-conventional lenders, last year, and actually the year before and last year. And we asked them a lot of key questions. We wanted to see what the average national rate was on return, and in this space, non-conventional lending space. So essentially a combination of all real estate, combination of, you know, resi and commercial and a little bit of owner occupied, right? Overall, national average still above 10, but barely above 10, right? And in conversations with national shops in residential fix and flip, that rate was much lower than 10. And also, the LTVs were much higher. And that just tells me that there's more risk in the market. And you really have to start thinking, can you sustain that risk? And do you have the protocols and the processes to sustain that risk? I have seen a lot of clients scale immensely fast, and they grow very, very fast. And with immense growth, you know, what really worked well for a team of 3-4 people, you know, having, you know, a messenger program and an Excel spreadsheet on workflow, changes when you have 30, 50, 100 employees. And that in and of itself can cause a lot of strain on a business. And so that's why about today's, you know, chat today is we wanted people to start thinking about, well, if we maintained our business model, we don't change too much, we just make sure we're operating well, you know, I think you can do a lot with that, and I think you can protect yourself significantly with that. And one of the things that, you know, we've done in the past as a firm is, you know, some of our clients that are very conscious about that have asked us to come pay them a visit and essentially look under the hood. And what that means really is, you know, we evaluate their business, we evaluate their processes, we evaluate their loan underwriting processes, what documentation they request from the borrower, their steps they go through in loan closings, record keeping, compliance with their investment materials, right? So if they've got a fund, does their business line up with their PPM, and does it cause any issues? Did they violate the terms of their PPM in any instance? That we also evaluate from a lending perspective. We'll look at their licensing and look at their compliance and see, have they violated local lending laws by doing X, Y, and Z. And in states that are heavily regulated like California, you know, have they violated their licenses regulations by, you know, exceeding a certain LTV or property type? And we'll also take a quick look at, you know, investor communications and reporting. That's something that's really we've been involved on, and making sure it's very important. Yeah, another question that we got on this was about investor reporting. So, you know, is there anything in investor relations that we can do to protect ourselves in the next recession? Absolutely, and I think there definitely is. That's probably one of the biggest things you can do, if you've got especially if you've got a fund, right? If you've got a fund, the investors are indirect investors, passive investors, and it's so important that they receive quality information, quality disclosures, but also not too much. We tell a lot of our fund manager clients, investors can often, you want to make sure you feed them just the right amount of information, because if you do too much, they could misinterpret it, and they can get scared because they're not as sophisticated as you are, right? So what I would say is think about, from an investor relations perspective, number one, the most important thing I can tell you is, get to know your investors. And I don't care if you're a crowdfunder, if you're fintech, if you're a small fund with 10 investors, get to know your investors. And the reason why I say that is that relationship that you have with the investors is going to help when you have to break some bad news to them, or when you have to kind of slow things down or say, hey, justify a change in returns or an increase in costs, because now they know that you are there to help them out. You are there to you're on the same team. So do that for sure. Another thing that is commonly overlooked is really make sure you deliver a high quality investor report periodically. A lot of our clients will send like a newsletter, and it'll kind of give a quick snapshot of the fund's performance. Other clients will do, a state of the fund type meeting once, twice a year. Other clients will, kind of open kimono, if you will, and just kind of let them look at anything they want. I always find a balance there. It's really important to think about not giving them so much information they freak out and that they start asking really irrelevant questions, but also delivering key performance indicators. One of some examples, are from a fund performance perspective is total capital, asset under management, average distributions year to date, historical distribution rates compared, if you've been around that long, if you ideally over the past 3 to 5 years, talking about the portfolio's performance, weighted average interest rate in the portfolio, concentration, geographic, asset class percentages, default rates, and loans in foreclosure, and based on geography and asset class. These are all kind of things you want to think about. And the reason why I say that is because lately investors are very, very sophisticated. Investors are also very, very tech savvy, and they're used to their robo-advisor in their Wall Street investments giving them all kinds of data. And you got to be able to deliver comparable data to them. It's not hard to pull, not hard to obtain. If you've got a loan servicer, they can probably provide most of it. If you've got a fund administrator, they can provide most of it. Your CPA can provide most of it. And then do it consistently and be open about it. One of the worst things you can do is hide the ball from your investors and make them feel like, oh my God, I did not know you had this many loans in default, right? And it's the truth, it's the truth that will really resolve a lot of problems there. A lot of my clients who face increasing default rates or troublesome loans have basically come clean with their investors, and their investors understand, and they want to know what's going to be done to fix it and move forward, and what their impact is going to be. But if you hide the ball and all of a sudden they see a decrease on their next statement, well, then now they're going to be upset. And now they may start calling their attorney. And now, that's when things get kind of pricey, and extra expenses to the fund are incurred. It's unnecessary. So yeah, investor relations, very, very important. So are there any other questions in the chat box here? No? All right, well, guys, that's pretty much it. I mean, I don't have anything else for you guys today. No other comments. If you like what you heard, make sure you hit the subscribe button below. If you're listening after the fact, please leave comments below. We're going to make sure we follow up with that. And there's more to come from Drosy LLP in this format, so stay tuned. Thank you.